Closing Bell is sponsored by TD Ameritrade.
Coming up on the 5-minute mark before the closing bell, and we're going to show you again those distinctions made that this October rally has done for the Dow, the NASDAQ, and the S&P, the best since January of '87, the best point gain ever. I mean, the magical month of October continues here. It helps with the European debt deal. It helps with the GDP numbers out this morning. You wonder whether this has legs, though. At some point, something has to give. But for right now, we enjoy it. The Dow back above the 12,000 mark. First time we've seen that since early August. The S&P now above its 200-day moving average, which was at 1274. So we're still comfortably above that level at this point. The euro is something to watch carefully. Does it have traction here? It's at a 7-week high now against the dollar. Does it continue? The dollar itself, the biggest decline against the backs of the currencies overall in 2.5 years. Has the currency market turned as a result of this debt deal? That's something to keep an eye on right here. But with the dollar lower, all the risk-on trades were in place. The 10-year yield down sharply today in price, so the yields were up sharply. That 7-year note auction just got lost in all the sauce today because of the excitement. The gold price moving sharply higher today, acting once again like a risk-on trade asset. The same thing for the price of oil. We talked earlier about how it was above $90 early in the week. That was resistance earlier. Now you heard Darren Wolfberg say that maybe $97 for WTI is in the offing. The one thing that I looked for when I got into work today was that VIX. Was there conviction to the downside there? And there has been. 25 is the level now. We haven't been there since early August when all this volatility began around August the 5th. Dave McEwen of American Century is still with us here, and I'm very interested in the smart people that you're not alone, who are still skeptical about the U.S. economy and what to do about that.
Hey, Robert.
You want to keep some powder dry here, don't you?
Yeah, the consumer is really in a bad way. They still have a tremendous amount of debt. The job market's weak, and housing prices keep going down. So that's 70% of GDP right there, Bill. So that's going to keep growth pretty contained for a while.
We've had an appreciable gain in yields here along the Treasury curve. Do you think that is is not going to last very long? Would you buy in at these levels here?
I think rates were really too low because we were really pricing in a double-dip recession. A double-dip recession we didn't really believe in, but it was priced in the market. So when yields were dropping like a stone, in our mind, that was an overreaction. So having yields back up a little bit here is completely consistent with our view.
You're keeping an eye on inflation-adjusted treasuries as well. Why?
Yeah, we have a large Treasury inflation-adjusted portfolio and a whole series of portfolios designed for inflation.
Do you think that the inflationary numbers are going to get worse before they get better?
CPI year over year is 3.9% right now, so it's already crept up quite a lot over the last couple of years. Really led by owner's equivalent rent, so rents are up. We're hearing that in apartment building rents are up, and there hasn't really been any construction. Plus, in the commodities, now that they're back up again, that's clearly coming through. So it's a different type of inflation than we've had in the past, but it is a concern.
All right, Dave McEwen, thank you for stopping by on the floor here. Don't forget to say hello to Jim Benham for me. I'll do that on the air, too. In case you're watching, Jim Benham, hello. Dave McEwen says hi as well. Bob Pisani, we've lost
100 points.
100 points on the Dow here in the last 30 minutes here.
And this was what was supposed to happen earlier in the day because there was a lot of Euro
from a lower level, right?
Right at the open, who was saying this isn't going to last. We still got problems with Italy and Spain. It's a good day, but it's not going to be a fabulous day. So they were wrong all throughout the day. We did have come off our highs, but let's not gainsay the great day we had here. Right now, up 13% for the month of October. This will be the best monthly gain for the S&P 500. We're just crunching the numbers now. Robert Hum's doing them. October 1974. If we hold these gains going into the end of the month, the best month of any month since October 1974. This put us over the top.
We've had a terrific year just this month.
That's right. Just this day, practically. We've had years when we haven't moved 3%. What is important is the breadth of the rally. 4% moves in financials, in industrials, materials, energy, and technology stocks. Really, the only group that hasn't had a great day are utilities and some of the consumer names, but even they're all right.
So you wonder this late in the cycle, this rally, whether this is a blow-off rally of some kind, ending it, or whether this is a new launching a new cycle here.
I think the numbers this morning on the economic numbers in the U.S. were pretty good overall. I think the important thing is if we continue to get decent numbers, it's going to bury the idea of a recession in the short term. We might get some good news on that front.
Thank you, Bob. That's it for the first hour of the closing bell. Maria has now hour number 2. I'll see you tomorrow.
And it is 4 o'clock on Wall Street. Do you know where your money is? Hi, everybody. Welcome back to the closing bell. I'm Maria Bartiromo on the floor of the New York Stock Exchange. Massive rally on Wall Street today as we're following at the close tonight. The market skyrocketing on Wall Street after European leaders came up with a debt deal that could stem the Eurozone's financial crisis. The market apparently believing this is the beginning of a fix. Investors also getting some good news out of the U.S. today after a GDP report showed the fastest growth in about a year. All the news pushing the Dow back above the 12,000 mark, putting the blue chip index on pace for the best October, best monthly point gain ever. S&P 500 on pace for the biggest monthly percentage move since 1974. All three major averages also set to close at a 3-month high. Is the rally sustainable? Should you put new money to work right here? A lot of questions about our nation's debt situation still looming. We've got some answers coming up. Meanwhile, take a look at how we're finishing the day on Wall Street. Things are settling out pretty strongly, even if they are off of the best levels. The market was up better than 400 points about 20 minutes or so ago. The Dow tonight up 340, nearly 3% at 12,209 on the Dow. Volume not bad. 1.3 billion shares traded here at the big board. NASDAQ up 88 points, better than 3%, 2738. And the S&P 500 tonight due to materials, energy, and technology and financials up 42 points, 3.5% higher at 1284. We've got all the angles covered for you on this rally. Simon Hobbs breaking down the European debt deal. Our market experts with the trades you can't afford to miss. But first, let's recap the rally with Bob Pisani. I'm in on the floor of the NYC right now. Bob.
Well, it wasn't 415 points in the Dow. We came off of the highs in the last hour, but 340 is still a remarkable day overall. And the important thing is heavy volume. We're going to do 6 billion shares. We haven't done that. That's the consolidated tape at the New York Stock Exchange. Take a look at the S&P 500 because there were plenty of skeptics this morning. People who sold the market or sold short going in. That turned out to be a very costly error. As a lot of people were betting things were going to drop off. The euphoria would die off in the middle of the day. That didn't happen. We just got stronger here. That forced a lot of people in. Rally even got stronger. Take a look at the sectors. I want to emphasize the breadth of the rally. 4%, 5% gains in all of the big sectors, tech, energy, industrials, materials, and financials. Some of the consumer names were the only ones that really didn't participate in the rally that much. How about the financial names? Not the financial names in Europe, the financial names here in the United States. That's right. That's not a typo. 16% gain in Morgan Stanley and very healthy gains in Citigroup, Bank of America, all the big guys, JP Morgan and Goldman, also 9% gains. How about what else was going on? The VIX, we emphasize that all day. It has been 30 to 48 in the last couple of months. It has rarely been below 30. Look at that drop to 25 right now. And a lot of people have been betting that it would eventually go back to its long-term average, which is in the 20-21 range. Selling volatility has proved to be a very costly gamble right now. Today, that was certainly the right thing to do. How about everything else? I just want to emphasize the rally and what it's looked like this month. This is the S&P Energy basket of energy stocks the last 3 months. You see the low it hit in the beginning of October? Look how that has moved up. We have essentially regained 80% of the losses that we have had going into the month of August when the big drops actually occurred. That's quite a move to the upside. Finally, Maria, the only thing that really did not participate in the rally to any great extent, some of the consumer stocks, Hershey and Clorox, American Express had a nice day, but Avon, the rest of them fairly flat on the day.
Yeah, Avon, big loser today. Bob, thank you so much. Bob, it's time we get breaking news right now. Apparently, Hewlett-Packard's going to keep the PC division. Right to John Ford. He has breaking news on Hewlett-Packard. We're probably going to see an impact in this stock. John, over to you.
Yeah, Maria, HP saying it's keeping the PC division and specifically saying that the cost of breaking it apart would be greater than the benefits that would accrue from splitting it off into a different division, saying that after going through the review, they realized this. Now, what's puzzling about this, of course, is that Meg Whitman, the new CEO, completed this review. She was on the board before. Why didn't they do this analysis before they announced that they were strongly considering spinning off the division? You would think you would analyze it first. But now they have. They're not spinning it off. And you see right now the stock, I believe, is halted. But supply chain and IT, all of those things factoring into why they are keeping it as part of HP, saying that they are confident that it will be able to sustain profitable growth. I will add that the cash flows from this business are very strong, something I pointed out several times before. If they're going to continue any kind of an acquisition strategy, they need cash flow. So it makes sense to keep this. It was always a bit of a head scratcher why they would spin it out, but we don't know how analysts will respond to this change in gears, Maria.
Yeah, I mean, the question, once again, goes to the board, doesn't it, John? I mean, all of these decisions that first they tell the market they're going to spin off the division, then they fire the CEO who the board hired. That's the third CEO that the board hired and fired. And now they change direction completely. I mean, what, no thinking of this out beforehand, right?
Well, I guess in their defense, they never definitively said that they would spin out the division. They said that they were inclined to do that and were going to consider strategic alternatives, which everybody took to mean that they would also consider selling it. But even so, you know, part of what I heard from within HP is they felt like they had to make this announcement before they could even begin considering those strategic alternatives. But everybody across the industry I talked to says, hey, that's just not the case. Other companies that have done spin-offs in the past have considered it in-house, made a decision, and then announced that to the market. That's what IBM did when it spun off its PC division. So this, very strange. You have to hope that Meg Whitman has got this on course now. Now this is behind them, Maria.
Yeah, for sure. John, thank you so much. Let's get more on this top story. We don't point out, though, the Hewlett-Packard stock is not halted. It is open in the extended hours, but not much reaction to this news. Let's get to Simon Hobbs now. He has more on the EU debt deal. Walk us through the deal, Simon, and your thoughts about it.
Well, you know, ultimately, Maria, for the Eurozone's leaders to fundamentally save their bloc from disintegration, they've got to prevent contagion spreading to Italy and Spain. And that ultimately overrides everything. Greece or recapitalizing Europe's banks now for the damage that's been done so far. Now, the leaders are quite clear. The EFSF bailout fund will be their vehicle to halt contagion. It will buy Italian and Spanish bonds in the open market to support prices and keep down interest rates at which the Italian and the Spanish governments borrow. But there's only about 250 billion euros left in the EFSF that's not already committed. The leaders promise to what they call leverage it up 4 or 5 times, basically to boost their fund's firepower towards $1 trillion. But there's no extra money in that tonight. What they're actually saying to the rest of the world is, hey, come and lend us $1 trillion. If the money doesn't come, the plan is dead in the water. OK, so let's say that the Chinese lend Europe $1 trillion, for the sake of argument, that they lend Europe roughly 1/3 of Beijing's entire foreign exchange reserves. Now, the EU leaders say that the deal in return will be for the Eurozone's governments, through the EFSF, to compensate the Chinese for the first 20% of any losses that they suffer. Let's turn the graphic upside down and think of it this way. That means that if a battle breaks out to save Italy and Spain and the losses start occurring in the bonds, European governments through the EFSF will immediately absorb 100% of all the losses. So in return for the greater firepower, the lenders are massively amplifying the risks for the European taxpayer, from 20% of any losses in the fight to 100%. So the question soon becomes, at what point countries like France would lose their AAA credit ratings. Maria, back to you.
All right, Simon, thanks so much for that analysis. We break down the day's actions, how you want to invest around this news out of Europe with Ben Pace. He's the U.S. Chief Investment Officer and Head of Global Investment Solutions Americas for Deutsche Bank. As well, Rachel Carroll is a consulting client executive for Russell Investments, and Chad Deakins, portfolio manager for Ridgeworth International Fund. Good to have you on the program. Thanks very much for joining us. Ben, let me kick this off with you. Your thoughts on the developments out of Europe. You know, every day there's another reaction in the market here. How do you see it?
You know, I think what we've done is we've decreased the risk of a credit freeze, a 2000-like credit freeze coming out of a bad European resolution. So we decreased that risk last night. overnight, in addition to the month of October, we decreased the risk around a U.S. recession. That's not what we're worried about anymore. So that's why the markets are getting back to, and probably will get back to, the levels that they traded at back in late July. Once we get there, then we'll see where we go, because we still have another risk, and that's the U.S. policy risk. The special committee deliberations have been pretty quiet. Now we're starting to get news items that the partisan acrimony is back. So I'll enjoy the ride up to about 1345, 1350 on the S&P, and then reassess there.
Chad, we know that valuations in Europe have been plummeting. A lot of people say it's overdone, and even the industrial companies there are getting hit with this negative sentiment, even though they have nothing to do with any of the debt stories. Are you invested in Europe right now?